There's a strange moment that happens right before someone loses money in the stock market. Not when they buy, not when the chart collapses, not even when the headlines start screaming panic. It happens earlier than that, much earlier. It happens the moment they stop thinking for themselves. The moment they start believing that somewhere out there's a smarter person, a richer person, a man in a suit on television who must know something they don't. And from that moment on, they stop observing reality. They start following noise. That's the world Peter Lynch walked into. A world filled with analysts pretending certainty, fund managers hiding insecurity behind complicated language, ordinary people convinced investing was a secret club designed to keep them out. And yet, somehow, one man quietly outperformed almost everyone. Not through genius predictions, not through mathematical wizardry, not by timing crashes, but by noticing something embarrassingly simple. The best investment opportunities were often sitting right in front of people, while they were busy looking somewhere else. This is one up on Wall Street. But beneath the investing advice, beneath the famous stock picks, beneath the numbers, this book is really about human blindness, about why crowds miss obvious things, why people trust strangers more than themselves, why intelligence alone doesn't protect people from financial disaster, and why ordinary people, people with no Ivy League degree, no trading floor, no insider connections, sometimes see reality more clearly than professionals ever do. Because Wall Street has always had one weakness: it underestimates normal people. The strange thing about financial markets is that they don't just reveal economic behavior, they reveal emotional behavior, fear, ego, envy, greed, insecurity. The market is one of the only places on earth where intelligence can become a disadvantage, because smart people often overcomplicate what simple observation would reveal immediately. Peter Lynch understood this better than most. While analysts buried themselves in reports and forecasts, he looked at parking lots, restaurants, shopping malls, products people couldn't stop buying. He watched human behavior before he watched spreadsheets. And that changes everything. Because most people think investing begins with numbers, Lynch believed it begins with attention. Real attention, the kind almost nobody practices anymore. Imagine this. A woman walks into a grocery store and notices a new product constantly selling out. Teenagers won't stop talking about it. Shelves empty faster every week. People return specifically to buy it again. She experiences the company before Wall Street fully notices it. That's the advantage, not secret information, reality itself. The professionals often arrive late because they are trapped inside systems, committees, approval structures, public expectations, complexity. Meanwhile, ordinary people move through real life every single day, collecting signals without realizing it. But here's the tragedy. Most people don't trust their own observations. They assume expertise lies somewhere far away, on television, inside hedge funds, behind technical jargon, so they ignore the evidence unfolding directly in front of them. And psychologically, this happens everywhere in life. People ignore what they feel, guess patterns they notice, guess intuition built from experience. Because modern society trains people to distrust themselves, especially around money, especially around power, especially around institutions. Lynch wasn't selling fantasy. In fact, one of the most uncomfortable truths in the book is that investing is often painfully boring. The public imagines stock market success as adrenaline, fast trades, urgency, brilliance, but real wealth creation usually looks quiet, almost invisible, and human beings hate invisible progress. That's why people sabotage themselves financially, because emotionally, doing nothing feels irresponsible. So they chase movement. Action creates the illusion of control. A stock rises rapidly. People panic buy because they fear exclusion. A stock crashes. People panic sell because they fear humiliation. Very few decisions are actually logical. Most are social. People don't just want profits. They want emotional safety. They want to feel aligned with the crowd, and that desire destroys them. Lynch saw this constantly. People would ignore strong businesses because they sounded boring, then throw money into companies they didn't understand because everyone else sounded excited. Think about how strange that is. In normal life, people avoid things they don't understand. But in markets, confusion often increases attraction, especially if the story feels glamorous. That's where ego enters the picture. People don't buy stocks only to make money. Sometimes they buy them to feel intelligent, to feel ahead of others, to feel important. And the market punishes emotional vanity with brutal efficiency. There's a scene that quietly repeats itself across decades. A man sits at dinner with friends. Someone casually mentions a stock that doubled. Suddenly the atmosphere changes. The room becomes psychological. People feel behind, inferior, excluded. Nobody says it directly. Money has a social gravity. It affects identity, self-worth. And Lynch understood that investors rarely operate from pure rationality, because humans rarely operate from pure rationality. Most financial behavior is emotional behavior disguised as logic. That's why people hold losing stocks forever. Selling would force them to admit reality, and reality attacks ego. So instead they create stories. It'll come back. The market is wrong. I just need to wait. Not because evidence supports it, because psychologically, hope feels less painful than acceptance. At the same time, people often sell winning stocks too early. Why? Because humans become uncomfortable with success too, especially uncertain success. The moment profit appears, fear appears with it. What if I lose it? So people escape the anxiety by selling too soon. The irony is devastating. They hold losers emotionally and abandon winners emotionally. Fear controls both decisions, just in different disguises. One of Lynch's most powerful ideas is hidden beneath a deceptively simple observation. You don't need to discover every great company, just a few extraordinary ones. That changes the emotional pressure completely, because modern investing culture feels obsessive. People think they must predict everything, understand every industry, follow every headline, rhetoric constantly. But Lynch approached investing more like a hunter, piquant observation, waiting, recognizing, and most importantly, avoiding unnecessary stupidity. That's harder than it sounds, because markets constantly tempt people into emotional reactions. Every day brings predictions, warnings, urgency. Financial media survives by manufacturing emotional volatility. Calm people don't consume non-stop news. Anxious people do. So the system rewards fear, rewards overstimulation, rewards impulsiveness. And over time, people lose the ability to distinguish information from noise. Lynch knew something terrifying. The more people obsess over short-term movement, less they actually see. Because constant noise destroys perspective. Imagine planting a tree, then digging it up every 2 days to check if the roots are growing. That's how many people invest. Constant interruption, constant fear, constant second-guessing. And then they wonder why nothing compounds. But one-up on Wall Street isn't just about stocks. It's about perception itself, about learning to see reality before consensus approves it. That's psychologically difficult because human beings crave social confirmation. We want agreement before action, but by the time everyone agrees something is valuable, opportunity often disappeared long ago. That applies far beyond investing. Careers, relationships, technology, culture. Most people only believe something after society validates it. Peter Lynch built his philosophy around the opposite instinct. Observe first, trust evidence, gis prestige. Because prestige can blind people, especially in finance. Some of the smartest looking people in the world make catastrophic decisions while sounding incredibly confident. And confidence hypnotizes people. Humans naturally associate certainty with competence, even when certainty is completely disconnected from reality. That's why complicated language becomes dangerous. It creates artificial authority. Lynch had little patience for this. He often stripped investing down to embarrassingly human questions. Do people love the product? Is the company growing? Does the business actually make sense? Simple questions. But simplicity threatens people who built identities around complexity. And socially, people often fear sounding simple more than being wrong. There's another uncomfortable truth underneath this book. Most people don't fail financially because they lack opportunity. They fail because they lack emotional stability. That's harder to teach, much harder, because emotional stability doesn't feel exciting. Nobody wants to hear that patience matters, discipline matters, temperament matters, especially in an era addicted to immediacy. People want shortcuts because shortcuts promise escape, a class from uncertainty, a class from slow progress, escape from ordinary life, and financial markets exploit that desire endlessly. Every cycle creates new fantasies, new narratives, new can't-miss opportunities, new emotional manias. But beneath every bubble, Human psychology stays almost identical. Greed expands, doubt disappears, crowds become euphoric, then reality returns always. And suddenly everyone claims the warning signs were obvious, but they weren't obvious emotionally. That's the point. During collective excitement, social pressure distorts perception. People don't want truth, they want belonging. That's why independent thinking feels lonely, even dangerous, especially when crowds are making money. Lynch repeatedly emphasized the importance of understanding what you own, because understanding creates emotional resilience. Without understanding, people borrow conviction from crowds, and crowds eventually panic. One of the most fascinating psychological ideas in the book is this: the market rewards observation before intelligence. That sounds offensive to highly analytical people, but look carefully at reality. Some investors become trapped inside abstraction. They study macroeconomics endlessly, yet miss obvious changes in human behavior happening around them. Meanwhile, someone else notices a small company quietly becoming part of everyday life. A store always full, a product spreading organically, customers emotionally attached to a brand. That person may lack technical sophistication. They're observing reality directly, and direct reality is incredibly powerful. Lynch believed ordinary experience was undervalued data. That's why he encouraged people to pay attention to the world they already lived inside. Not because investing is easy, but because human behavior leaves clues everywhere. Most people simply stop noticing, or worse, they notice something valuable, then dismiss themselves. I'm probably wrong. Professionals would know better. That sentence alone has probably cost ordinary people fortunes throughout history, because expertise is often reactive. Reality moves first, institutions move later, and then there's one of the darkest emotional traps in investing: the illusion of certainty. People desperately want guarantees, so they cling to forecasts, predictions, targets, experts. But Lynch repeatedly exposed how unreliable forecasting actually is. Nobody truly knows what markets will do short term. Nobody, yet humans feel psychologically uncomfortable admitting uncertainty. So instead, they create narratives. And narratives are emotionally addictive. A convincing story feels safer than ambiguity, even if it's false. Especially if it's false, because emotionally satisfying stories spread faster than nuanced truth. That's true in finance, politics, media, social life. People don't naturally reward accuracy, they reward confidence, and markets punish that weakness relentlessly. Lynch's mindset was radically different. He didn't need certainty, he needed probability, patience, observation, enough understanding to remain calm while others became emotional. That emotional steadiness becomes a massive advantage, because panic distorts intelligence. Excitement distorts intelligence too. Most people think danger only exists during fear. But euphoria can be even more destructive. Fear makes people run away from opportunity. Euphoria makes them run toward disaster. There's a deeper philosophical layer beneath One Up on Wall Street. A quiet rebellion against dependence. Lynch was essentially telling ordinary people, you are more capable of understanding the world than you've been taught to believe. That idea is psychologically powerful, because modern systems often encourage passivity. Wait for experts, wait for permission, wait for consensus. But independent observation creates freedom. Not perfect certainty, freedom. The freedom to think without emotional submission to crowds. And that's rare. Most people inherit financial beliefs emotionally from family, culture, media, and fear, long before they ever study money logically. Some grow up believing investing is gambling. Others believe wealth belongs to other people. Others associate money with anxiety so deeply that they avoid learning altogether. These emotional inheritances silently shape behavior for decades. Lynch challenged that passivity, not by pretending markets are easy, but by reminding people that curiosity itself has value, attention has value, independent thinking has value. And ironically, market often rewards people precisely when they stop trying to appear sophisticated. There's a moment many investors eventually experience, a painful realization. The biggest enemy was never the market, it was themselves, their impatience, their insecurity, their need for validation, their inability to sit quietly while uncertainty existed. Because uncertainty feels unbearable to the human mind, people would often rather make a bad decision than tolerate ambiguity. At least action creates temporary emotional relief, But Lynch understood something timeless. Activity is not intelligence. Movement is not progress. And noise is not insight. Some of the greatest investments looked unimpressive in the beginning. Tech companies, civil businesses, unglamorous industries. Meanwhile, attention flowed elsewhere toward spectacle. That pattern repeats constantly in human life. People overlook what quietly works because they're hypnotized by what loudly performs. But substance rarely announces itself dramatically at first. Usually it grows slowly, silently, while the crowd is distracted. And maybe that's the real lesson hidden inside this book. Not how to beat Wall Street, but how to see clearly in a world addicted to emotional manipulation. How to remain psychologically grounded while crowds swing between greed and fear. How to trust direct experience over collective hysteria. How to separate reality from performance. Because financial markets are ultimately mirrors. They expose human nature in accelerated form. Our fear of missing out, our hunger for status, our addiction to certainty, our discomfort with patience, our vulnerability to stories. And maybe that's why this book still matters decades later. Not because specific stocks mattered. Most are forgotten now. But human psychology hasn't changed. Crowds still chase excitement. Media still monetizes panic. People still confuse complexity with intelligence. And ordinary people still underestimate the value of their own observations. Peter Lynch saw opportunity where others saw ordinary life. That's what made him dangerous. Not because he predicted the future perfectly. Not because he understood people. He understood that markets move through human emotion, long before they move through numbers. And once you realize that, you stop seeing investing as a cold mathematical game. You start seeing it for what it really is, a psychological battlefield. One where the greatest advantage isn't genius, it's clarity. The ability to remain calm while others become emotional. The ability to observe honestly while others perform certainty. The ability to think independently while crowds desperately search for reassurance. That's the real meaning of being one up on Wall Street. Not superior intelligence, superior awareness. And in a world drowning in noise, awareness becomes power.